This video will change your way you look at investing, and I don't take this lightly. You will see long-term data you've never seen before. You will learn things that a lot of people don't want to tell you. And I don't make this video longer than it has to be. Let's start off with this chart. It begins in 1985, so that's almost 40 years of data. And it's something you very likely have never seen before. This is the Nasdaq divided by the S&P 500. So it shows the relative performance of tech stocks to the rest of the market. And it shows it on a very, very long-term scale. And obviously we see how the tech stocks outperform the rest of the market over time. We also see a bit of a spike over here. What is this? This spike is the dot-com bubble in 2000. There was a brief period of time where tech stocks underperformed the rest of the market by 67%. But if you take away that bubble, over the long term, more and more value of the US economy concentrates in technology. Why is this happening, and what kind of implications does this give to us? It's happening because of fundamental advantages that technology has over the rest of the economy. Technology can scale at pretty much no cost. You develop the software once, you can serve the entire globe, and each additional user that you onboard doesn't cost much. That's very different to the rest of the economy, where each new unit has to be produced, where you might have to build factories all around the world, where you have to establish logistics everywhere. With technology, the tendency is that your margins do not shrink as you're expanding the business. And as such, technology makes more and more money. And as such, technology stocks over the decades outperform the rest. This is a super important learning. I think it has fundamental implications on how to allocate capital for retirement, for example. Do you really want to own S&P 500 ETFs mainly in your 401k? Or do you maybe want to own QQQ, a Nasdaq ETF? I think the latter will be way more beneficial, and a chart of almost 40 years of data supports this. This is a very, very powerful chart. And I hope I wasn't over-promising that this video will change the way you look at investing. There's two more very similar charts that bring us similarly strong takeaways. If you so far find this useful, please give this a like and spread the word. This chart is even longer in duration. And again, it's a chart you likely have never ever seen before. It starts in September of 1904. So that's almost 120 years of data. There's a vertical line here. This is Bretton Woods. There's a little arrow over here. This is an ETF launch. That chart is the gold price denominated in the S&P 500 price. So gold divided by SPX. Why is this useful? Because it looks at things like, is gold a good inflation hedge? How does gold long-term perform? Are there maybe even ways to time this? Should we own any gold in our portfolio right now? And if yes, how much? The waves that we see in this chart are absolutely stunning. This is Bretton Woods. This is when the US dollar lost its backing. So August of 1971, this is when many people rushed into gold. They sold their stock, they bought gold, and gold outperformed the S&P 500 by 1,270%. This is not small fluctuations, this is huge. Then starting in the 1980s came the technology boom. And so gold underperformed the S&P 500 by 97%. So if you held gold during those 20 years, 1980 to 2000, you would have lost, relatively speaking, 97% versus stocks. You would have more than 30 times the purchasing power had you allocated from gold to stocks at the beginning of the 1980s. These kinds of decisions, they truly matter. Now then came the dot-com burst, and people looked for a flight to safety. And then from 2000 to 2011, gold outperformed the S&P 500 by 700%. And then came the introduction of Bitcoin. And gold lost, relatively speaking, and continues to be on a somewhat constant downward trend again. So gold is really no clear hedge against inflation. The volatility is massive if you just measure it versus the S&P 500. You could also measure it versus M2. It's not that different. Gold does not protect against monetary expansion that well. It's like any investment driven by the psychology of the markets. If everybody thinks that fiat becomes worthless, then people buy gold. If there's something better than gold, then gold loses market share. If technology expands and everybody gets hyped up around where to get new returns, then stocks massively outperform. I don't really see a strong case to have a massive allocation to gold right now. What would really be driving this? The new generation hedges themselves against inflation, not with gold, but with Bitcoin. That's where the psychology now is moving. The 30 to 40-year-olds are the ones that now save the most. Those are the ones that now allocate towards investments. And they are not buying gold. Gold is sold by the older generation that is now retiring and that's giving the money via inheritance to the younger generation. I think this gold relative valuation chart is super powerful as well. Very few people know about how much gold actually fluctuates, relatively speaking, and how much the relative pricing is actually influenced by the timegeist of the day. The current timegeist is not in favor of gold. And you don't have to follow the news every day, right? These waves, they are 10 or 20 years in duration. We've got one more chart to go. In case you haven't yet subscribed, feel free to do so, by the way. I publish videos on this channel regularly. In the next chart, we are going to look at monetary expansion. And we are going to debunk the myth that stocks really generate value for their holders. This here is an S&P 500 chart you have never seen before. It's the S&P 500 divided by M2, the money supply. What can we see here? We can see that the growth is extremely slow. In fact, there hasn't been any growth in the last 30 years, roughly. Right? This is at the same level as March of 1997, 25 years of no appreciation relative to the monetary expansion, relative to the money printing. So what does that mean? It means that when allocating to stocks, you're not necessarily becoming richer because the companies are doing so great, at least in aggregate. You're just becoming richer on paper. The numbers going up, you're impacted less by inflation. And that's the tricky part around inflation, right? That's why we have these baskets. Most products, they deflate in price. They're easier to produce over time. Technology advances, and so making food, for example, is easier today than 100 years ago, when we needed all of those farmers doing all the manual work. Now we've got all the machines. So goods should be becoming cheaper with time, not more expensive. But especially for products and services where we can't automate that much, we see the true inflation. We see the prices going up with M2. We don't just see them go up by 2 or 3% over the decades. We see them go up by 7 or 8%. For example, for education or for medical expenses. And that's where you can simply just keep your purchasing power by buying into stocks in aggregate. So how is this useful? It's useful to time the market to a degree. When we are crashing, when we are at lows that we have barely seen in the past, it might make sense to dollar cost average in heavier. And when we are at historical highs, which is currently the case, right? We probably shouldn't over allocate too aggressively. There's probably a lot of risk in the market. Don't see your stock investments as a vehicle to become rich. See them as a vehicle to preserve purchasing power and take advantage of those fluctuations that happen over the years. If a real crash happens, monetary expansion will be massive, new money printing will come, and one might even consider taking a loan during those times, because the debt, relatively speaking, to the assets will depreciate with more printing. So here are the 3 takeaways for me personally. I buy tech stocks rather than all of stocks for my retirement. I don't allocate to gold until momentum turns around and there's a new narrative around gold. And I double down whenever stocks go down because I expect monetary expansion to follow. Money will be valued less And just buying and holding stocks is not a vehicle to become rich, but just a vehicle to stay afloat. Feel free to subscribe in case you haven't yet. A like is appreciated as well. And if you've got Telegram, feel free to join us. Search for Bitcoin Strategy Channel within the Telegram app or click the link down below. I hang around there regularly. Looking forward to chatting with you. Bye-bye.